Liquidity crises rarely announce themselves. They do not arrive with sirens, emergency votes, or dramatic headlines. They surface quietly through absence rather than presence. A bid that fails to appear. A funding line that is not rolled. A market that opens on time but is not clear at expected prices. Volatility rises, yet no single cause is named. Commentators search for news, but the news is missing. What matters is not what happened, but what stopped happening. This is how the most consequential liquidity shocks begin. Not with collapse, but with hesitation. Money still exists, balances remain intact, and institutions continue to operate. Yet something subtle changes beneath the surface. Capital becomes cautious. Collateral circulates more slowly. Risk premiums widen for reasons that feel disconnected from events. The system still functions, but less smoothly, less generously. These are not failures, they are warnings that rarely trigger alarms. In 2008, the warning signs were unmistakable. Credit markets seized after years of leverage, and panic spread openly through banks and balance sheets. Central banks responded visibly, injecting liquidity at unprecedented scale. In March 2020, the shock was even faster. A global shutdown froze commerce, Treasury markets buckled, and the response was immediate and overwhelming. In both cases, the cause was clear, the reaction decisive, and the crisis recognizable in real time. The shock examined here did not look like that. There was no single moment of rupture, no cascade of bankruptcies, no sudden recession at the outset. Markets continued trading, economies continued growing, and official narratives emphasized resilience. Yet beneath those surfaces, core funding markets began behaving strangely. Treasury auctions showed inconsistent demand. Repo rates spiked without obvious stress. The dollar strengthened even as deficits expanded. Volatility appeared where stability was expected. These signals were easy to dismiss precisely because they did not resemble crisis. Analysts treated them as technical anomalies, temporary dislocations, or policy noise. Each episode could be explained away. Taken together, they formed a pattern that few were prepared to see. Liquidity was thinning, not evaporating. And thinning is far more dangerous because it delays recognition while reshaping behavior. This documentary argues that America's largest liquidity shock was not triggered by panic, war, or a single policy error. It emerged from a structural shift that unfolded gradually and externally. A reconfiguration of global dollar flows altered the system's internal balance without announcing itself as a threat. The shock was cumulative, not explosive. By the time it became visible, it had already done its work. China enters this story not as an adversary, but as a systemically significant participant whose financial evolution intersected with American assumptions. For decades, the global dollar system relied on predictable recycling of surplus capital back into U.S. markets. That assumption became invisible through repetition. When it began to change, the system did not break. It adjusted unevenly and silently. History offers a consistent lesson here. Empires do not lose monetary primacy when their currencies collapse. They lose it when liquidity control slips beyond their awareness. Flows reroute. Settlements change. Confidence erodes not through fear, but through friction. By the time leaders recognize the shift, it is no longer reversible. The question that follows is not one of blame or intent. It is one of mechanism. How could decisions made far from Washington quietly drain liquidity from the world's deepest financial system without confrontation, without crisis, and without warning? What makes this kind of shock especially dangerous is that it rewards complacency. Systems built for abundance do not fail immediately when flows thin. They mask stress through complexity and delay. The absence of crisis becomes evidence of safety. That illusion persists until adjustment becomes unavoidable. By then, the origin of the problem is no longer visible. Liquidity is often mistaken for money itself. It is not. Liquidity is movement. It is the ability of capital to circulate without friction, to settle transactions reliably, to be pledged as collateral, and to reprice risk without breaking the system that supports it. A nation can be wealthy on paper and still illiquid in practice. When liquidity weakens, power weakens, regardless of how much currency exists in aggregate. For modern empires, liquidity functions as an operating system. Gross domestic product measures output. Military capacity measures force. Trade volumes measure exchange. Liquidity measures whether those elements can be mobilized, financed, and sustained under stress. When liquidity is abundant, systems absorb shocks. When it tightens, even strong economies become fragile. This is why liquidity, not production, has always determined imperial endurance. History reinforces this distinction. The Roman Empire did not fall because it ran out of grain. It faltered when tax grain arrived late, when transport routes slowed, and when the flow of resources from provinces to the center became unreliable. Britain did not lose global influence because it stopped producing goods. It lost monetary primacy when sterling shortages constrained settlement and forced painful adjustments across its empire. After the Second World War, even gold-backed systems strained when settlement demands exceeded available reserves. In each case, resources existed, but flows failed. The modern liquidity architecture is more complex, but the principle is unchanged. At its core sits a layered structure built around U.S. Treasuries, dollar funding markets, repo, collateral chains, and global reserve recycling. Treasuries are not merely government debt. They are the foundation of collateralized finance, the asset that allows institutions to lend, hedge, and clear at scale. Dollar funding markets connect banks, corporations, and states across borders. Repo markets link collateral to short-term liquidity. Together, these layers form a single circulatory system. Since 1945, American power has rested on maintaining this system. The United States supplies the world with assets that are liquid in good times and trusted in crisis. When stress appears elsewhere, capital moves toward U.S. markets, not away from them. This inward flow stabilizes the system and lowers financing costs. It also allows the United States to absorb excess capital generated by global trade imbalances. But this architecture is not self-sustaining. Liquidity dominance requires cooperation from surplus nations. Exporters accumulate dollars through trade, and the system depends on those dollars being recycled back into U.S. assets. This recycling maintains demand for treasuries, stabilizes funding markets, and keeps the circulatory system open. If that cooperation weakens, nothing collapses immediately. There is no attack to repel and no crisis to announce. Instead, flows adjust. Marginal demand shifts, liquidity thins. What follows is not confrontation, but destabilization by withdrawal. The modern dollar order emerged from the ruins of the Second World War. In 1944, at Bretton Woods, the architecture of global finance was rebuilt around a single anchor. The United States, holding the majority of the world's gold reserves and possessing unmatched industrial capacity, assumed the role of monetary center. The dollar became the reference point for trade, reserves, and settlement. Other currencies aligned to it. Confidence flowed from structure, not rhetoric. At the heart of this order was an implicit bargain. The United States would run external deficits, supplying the world with dollars needed for trade and growth. Surplus nations would accumulate those dollars as reserves, and those reserves, rather than remaining idle, would be reinvested back into U.S. financial markets, primarily through Treasury securities and dollar-denominated assets. This recycling closed the loop. Dollars left the United States through trade and investment, then returned to finance deficits at low cost. For decades, this system proved remarkably stable. Even as imbalances grew, the mechanics held. The dollar was scarce enough to be valuable, yet abundant enough to lubricate global commerce. Trust in the system was not ideological, it was operational. Dollars cleared everywhere. Treasury markets remained deep and liquid. In moments of stress, capital flowed toward the center rather than away from it. That behavior reinforced belief, and belief reinforced behavior. The closing of the gold window in 1971 did not end this order. It transformed it. Settlement shifted from metal to confidence, from convertibility to credibility. The dollar no longer promised gold, but it promised liquidity. It promised that obligations could be met, markets would function, and assets could be sold without disorder. Over time, this proved more flexible than gold, not less. The system expanded as global trade expanded. China entered this framework later, but at scale. After integrating into global trade networks, it became the largest generator of trade surpluses in the system. Those surpluses accumulated as dollar reserves. For years, China recycled those reserves back into U.S. treasuries, reinforcing the existing order. The effect was stabilizing. Treasury yields remained suppressed. Funding markets remained liquid. The recycling pact held. This arrangement benefited both sides. The United States financed deficits cheaply and maintained monetary centrality. China secured export growth, reserve accumulation, and access to a stable settlement currency. The system did not require political alignment. It required participation, yet embedded within this structure was a critical asymmetry. Recycling was assumed, but never guaranteed. There was no enforcement mechanism, no treaty obligation compelling surplus nations to continue reinvesting in U.S. assets. The system functioned because it had always functioned. Compliance became habit. That assumption would eventually be tested. Not through confrontation or announcement, but through choice. When recycling slowed, it did not register as defiance. It appeared as portfolio management, as diversification, as prudence. The shift was not abrupt. It was decisive precisely because it was gradual. China's rise within the global financial system began quietly, as an extension of its role as the world's manufacturing platform. For years, growth was driven by exports priced in dollars, settled through Western banks, and absorbed by foreign consumers. The result was persistent trade surpluses that accumulated not as domestic spending power, but as foreign exchange reserves. Over time, those reserves reached a scale no modern economy had ever managed. Trillions of dollars in reserves transformed China from a participant into a systemically important liquidity provider. Its surplus dollars did not sit idle. They entered global markets, primarily through purchases of safe, liquid assets. This flow mattered less for what it earned and more for what it enabled: stable settlement, suppressed yields, and predictable funding conditions across the dollar system. China's surplus machine became a quiet stabilizer of global finance. But scale changes incentives. Once reserves exceed what is necessary for trade settlement and crisis defense, accumulation stops serving growth and starts introducing risk. Excess reserves expose the holder to valuation losses, political leverage, and dependency on foreign financial infrastructure. At that point, the strategic objective shifts. The goal is no longer to acquire more dollars, but to protect what has already been earned. This transition marked China's financial maturity. Rather than maximizing reserves, policymakers focused on insulation. Internal financial reforms strengthened domestic balance sheets and reduced vulnerability to external funding shocks. Capital controls were refined, not abandoned, to manage inflows and outflows with greater precision. Diversification strategies slowly adjusted reserve composition without destabilizing markets. None of these moves required confrontation. They reflected risk management by a large, exposed balance sheet. Crucially, these changes were driven as much by domestic stability as by external conditions. A surplus superpower must manage employment, credit growth, and social cohesion alongside external exposure. Allowing reserves to dictate policy becomes untenable at scale. Monetary sovereignty requires optionality, not dependence. For China, reducing reliance on a single settlement currency was a logical extension of economic development. This evolution follows a familiar historical pattern. Every surplus empire eventually seeks control over its monetary destiny. The Dutch, the British, and others reached similar inflection points when accumulation turned from advantage to constraint. Framed this way, China's behavior does not signal aggression or rupture. It reflects structural inevitability. The system did not change because intentions changed. It changed because maturity altered priorities. Seen from this perspective, the shift was gradual rather than dramatic. There was no announcement, no rejection of the existing order, and no immediate market signal demanding attention. Reserve management simply became more cautious, more diversified, and more aligned with long-term stability. For a state operating at continental scale, these adjustments were administrative decisions, not strategic declarations, yet their cumulative effect mattered. As priorities evolved from accumulation to preservation, behavior changed. And when the behavior of a surplus superpower changes, the systems built around its former habits inevitably begin to adjust. This closing frame matters because it removes moral judgment entirely, leaving only structure, incentives, and scale as explanatory forces within the evolution of global finance systems. The first structural break did not arrive as a headline event. It emerged as a shift in behavior, detectable only in aggregate and only over time. At a certain point, China stopped increasing its net holdings of U.S. Treasuries. There was no announcement, no sudden liquidation, and no visible rupture in markets. What changed was marginal demand. And in leveraged financial systems, marginal demand is decisive. For years, China had been among the largest consistent buyers of treasuries. Its participation anchored auctions, absorbed supply, and stabilized yields. When that participation slowed, the system did not fail. Instead, it recalibrated. Prices began to respond more sharply to smaller shifts in sentiment. Volatility increased without obvious catalysts. Funding conditions tightened intermittently, then relaxed, then tightened again. These movements appeared technical, even random, but they shared a common origin. Liquidity crises often begin not with selling, but with non-buying. When an asset is widely held and heavily collateralized, outright selling is disruptive and visible. Stepping back is quieter and more effective. When the largest marginal buyer no longer absorbs new supply, price discovery changes. Auctions clear at higher yields. Dealers carry more inventory. Balance sheets stretch. The cost of funding rises, not because assets are toxic, but because they are less easily financed. This dynamic is especially powerful in markets built on leverage. Modern treasury markets rely on continuous turnover, repo financing, and confidence that positions can be rolled without friction. When marginal demand weakens, these assumptions erode. Small disruptions propagate through funding chains. Volatility becomes endogenous, generated by structure rather than news. Markets still function, but with less tolerance for imbalance. Conceptually, the data reflected this shift. China's reported treasury holdings plateaued and then declined gradually. Reserve growth slowed even as trade surpluses persisted. The composition of reserves diversified incrementally, with adjustments in duration and currency exposure. None of these moves were dramatic in isolation. Together, they signaled a change in posture from accumulation to management. Crucially, this transition was invisible to the public. Markets do not collapse when liquidity thins. They misprice. They exhibit anomalies that analysts explain away as technical noise. Bid-ask spreads widen slightly. Repo rates spike briefly. Correlations break down. Each episode resolves just enough to avoid alarm. The system absorbs stress without acknowledging it. This is why the first break went largely unnoticed. There was no crisis to debate, no emergency to address. Policymakers and participants focused on growth, inflation, and policy cycles, assuming the plumbing remained sound. Yet beneath those discussions, the system's most important assumption had changed. A buyer that had once been reliable was now selective. That selectivity mattered because the system had been built around habit. Treasury issuance expanded on the assumption of steady foreign absorption. Funding models assumed deep, elastic demand. When those assumptions weakened, the structure did not adapt immediately. It continued operating as if past behavior would persist. This moment marks the first structural fracture. Not a break in confidence, but a break in flow. The machinery of global liquidity continued running, but with less fuel than before. The consequences were delayed, dispersed, and easily misunderstood. Yet once marginal demand shifted, the trajectory was set. The system would spend years adjusting to an absence it had never learned to measure. Financial sanctions and payment system leverage are often described as the turning point in this story. They were not. They did not initiate the liquidity shift. What they did was alter incentives in ways that made existing adjustments accelerate and spread. Weaponization changed calculations, not behavior that had already begun. When reserves are frozen or access to settlement systems is restricted, the immediate effect is visible and dramatic. Less visible is the structural consequence. Once reserves are shown to be conditional, they stop functioning as neutral liquidity. Assets intended to provide safety under stress instead become sources of uncertainty. Their value no longer rests solely on market depth or credit quality, but on political context. This distinction matters because global liquidity depends on trust that is mechanical, not discretionary. Reserve assets work only when holders believe they can be mobilized in any circumstance. When that assumption weakens, even slightly, reserve management changes. Institutions begin to ask not whether an asset is liquid today, but whether it will remain liquid tomorrow. China's response fits squarely within this logic. Adjustments to reserve composition and settlement exposure did not require retaliation or confrontation. They reflected risk management by an actor with a very large balance sheet and long planning horizons. Reducing vulnerability to external control was consistent with preserving stability, not challenging the system directly. Importantly, this response did not depend on intent or messaging. It followed incentive structures that any large reserve holder must consider. Once precedent exists, prudence demands adjustment. In this sense, financial weaponization functioned as an accelerant. It compressed timelines and clarified risks that had previously been abstract. The effect did not stop with one country. Reserve managers across the system observed the same signals. They did not need to coordinate, they only needed to adapt. Even small reallocations, when repeated across multiple actors, change aggregate flows. Liquidity begins to fragment, not because markets close, but because behavior diverges. This fragmentation is subtle. It does not eliminate the dollar's role or dismantle existing infrastructure. It introduces hesitation. Settlement choices multiply. Marginal demand becomes less predictable. Liquidity remains abundant in total, but less concentrated and less reliable in stress. Seen this way, weaponization did not break the system. It revealed its conditionality. By doing so, it shifted incentives from passive participation to active management. That shift, once begun, does not reverse easily. It spreads quietly, reshaping global liquidity without requiring confrontation, coordination, or crisis. It is this incentive shift, rather than any single policy, that altered behavior. Once neutrality is questioned, reserve assets are treated less as anchors and more as exposures. Management replaces habit. Over time, these choices compound. The system continues to operate, but with thinner margins and greater sensitivity. Fragmentation advances quietly, driven by precaution, not provocation. No declarations were necessary, only consistent adjustment across balance sheets responding to altered risk calculations. The effects of shifting dollar flows did not remain abstract for long. They began to surface where liquidity is most visible and most sensitive, the U.S. Treasury market. This is the deepest market in the world, the benchmark for pricing risk, and the foundation of modern finance. When anomalies appear here, they are never isolated. The changes were subtle at first. Volatility increased on days without news. Auctions cleared, but demand was uneven and occasionally weak relative to supply. Bid-ask spreads widened slightly, then normalized, then widened again. Dealers reported difficulty moving inventory without price concessions. None of this suggested crisis. Together, it suggested strain. Treasuries occupy a unique role. They are not merely government debt. They are collateral. They sit at the center of repo markets, derivatives margining, and balance sheet calculations across the global system. Their value lies not just in repayment, but in their ability to be financed, pledged, and converted into cash without friction. When that ability weakens, even marginally, the consequences propagate outward. Repo markets were among the first places where stress appeared. Funding rates spiked intermittently, then fell back, then spiked again. These moves were often dismissed as technical or calendar-driven. Yet they shared a common feature: collateral was becoming less fluid. Participants demanded higher haircuts, shorter maturities, or more selective terms. These adjustments signaled caution, not panic. Auction behavior reinforced the picture. Primary dealers absorbed more supply, increasing balance sheet usage. End-user demand became less predictable. Foreign participation fluctuated. None of this stopped issuance, but it altered price discovery. Yields responded more sharply to supply and less smoothly to policy signals. The market was still functioning, but with thinner buffers. What made these developments difficult to interpret was their timing. They did not coincide with recessions or financial headlines. Economic data remained strong. Policy debates focused elsewhere. The Treasury market's behavior appeared disconnected from the broader narrative. That disconnection was the signal. As confidence in collateral liquidity weakens, systems adjust internally. Leverage becomes more expensive. Arbitrage narrows. Market makers pull back incrementally. These responses are rational and self-reinforcing. They do not announce themselves. They accumulate. This is where the liquidity shock becomes measurable. Not through collapse, but through behavior. Volatility becomes endogenous. Funding costs fluctuate without warning. Correlations shift. Each symptom is manageable on its own. Together, they indicate a system adapting to reduced marginal support. Importantly, none of this required large-scale selling by foreign holders. The absence of consistent incremental demand was enough. When new supply is met with hesitation rather than absorption, the market must reprice. That repricing shows up as volatility and stress, even if total holdings remain high. By the time these patterns became visible, the adjustment was already underway. The Treasury market was signaling that one of its quiet supports had weakened. The shock was no longer theoretical. It was embedded in daily price action, funding rates, and risk management decisions. The most important market in the world was behaving differently, and it was doing so without explanation. The response of the Federal Reserve to emerging stress followed a familiar pattern. When volatility rose and funding markets tightened, rates were adjusted and balance sheets expanded. These tools had worked before, and they worked again in limited ways. Markets stabilized temporarily. Liquidity appeared to return, yet beneath the surface, the underlying adjustment continued. This is because the shock was not rooted in insufficient money creation. It was rooted in altered flows. Rate cuts influenced domestic borrowing costs and asset valuations. Asset purchases compress yields and inject reserves into the banking system. Both assume that liquidity shortages originate internally and can be corrected by supplying more dollars. Structural liquidity loss operates differently. The modern dollar system depends on circulation, not stock. Reserves created by central banks remain trapped within their jurisdictions unless counterparties are willing to exchange, recycle, and hold them. When foreign actors adjust their behavior, no amount of domestic easing can compel participation. Dollars can be created, but they cannot be forced to move where the system expects them to go. This constraint defines the limits of central banking power. The Federal Reserve can backstop markets during panic. It can smooth volatility, prevent disorderly liquidation, and provide time for balance sheets to adjust. What it cannot do is recreate external demand for U.S. assets when that demand weakens for structural reasons. It cannot mandate confidence. It cannot require recycling. This distinction explains why policy responses began to show diminishing returns. Each intervention addressed symptoms rather than mechanics. Funding markets calmed, then resurfaced under stress. Volatility subsided, then returned without clear cause. Balance sheet expansion stabilized prices, but did not restore elasticity. The system functioned, but with less margin. This reframes the idea of monetary omnipotence. Central banks are powerful within their domain, but that domain is bounded by incentives outside their control. Global liquidity is a cooperative construct. It relies on voluntary alignment between surplus holders and deficit issuers. When that alignment weakens, policy tools lose traction. Importantly, this does not imply failure or error. The Federal Reserve acted within its mandate and with considerable effectiveness. The limitation was structural, not institutional. A system built on external participation cannot be fully stabilized internally once participation changes. Understanding this boundary is critical. It explains why unprecedented easing did not resolve underlying stress. It clarifies why stability became episodic rather than durable. And it underscores the central argument of this documentary. The largest liquidity shock was not a policy mistake that could be corrected, but a structural shift that policy could only cushion, not reverse. It also reveals why confidence in intervention slowly changed character. Markets learned to expect support, but no longer expected restoration. Liquidity provision became a bridge, not a solution. Participants adjusted by shortening horizons, reducing leverage, and pricing risk more defensively. These adaptations were rational responses to a system operating with thinner external support. Central bank action remained necessary, but insufficient. It could delay adjustment, not eliminate it. The gap between what policy could promise and what structure could deliver widened quietly. In that space, uncertainty persisted, not because authority was absent, but because its reach had limits defined beyond national balance sheets. Those boundaries shaped outcomes regardless of intent, effort, or institutional credibility over time. The scale of this shock becomes clear only when compared to earlier crises. In 2008, the system suffered a credit collapse. Leverage built on fragile assumptions failed, losses cascaded through balance sheets, and trust evaporated almost overnight. The cause was internal, the damage visible, and the response direct. Liquidity vanished because counterparties doubted solvency. Once confidence was restored through guarantees and recapitalization, flows resumed. In 2020, the shock was different, but equally recognizable. Markets froze in response to sudden panic. Economic activity halted, risk was indiscriminately shed, and even safe assets were sold to raise cash. The response was immediate and overwhelming. Central banks stepped in as buyers of last resort. Liquidity returned because fear subsided and policy filled the gap. The shock examined here does not fit either category. It was not a collapse of credit and not a moment of panic. Balance sheets remained intact. Institutions continued operating. Markets did not seize. What changed was participation. Liquidity thinned because a key source of marginal support withdrew quietly. The system adjusted without breaking, which made the adjustment harder to see. This difference matters because credit crises and panic shocks are reversible. Once losses are absorbed or fear passes, behavior normalizes. Structural withdrawal is different. It reflects a change in incentives, not emotions. When a large actor reduces its role, the system must adapt permanently. There is no moment when confidence suddenly returns, because confidence was not what left. In this case, the withdrawal affected the foundation rather than the surface. The global system had been built on the assumption of continuous recycling into U.S. assets. When that assumption weakened, liquidity did not disappear. It became less elastic. Markets still cleared, but with greater sensitivity. Volatility increased, not as a spike, but as a baseline. Funding costs fluctuated more often. Risk tolerance narrowed. This is why the shock was larger than 2008 in structural terms. The financial crisis forced repair. This shift forced redesign. The system could no longer rely on past habits to function smoothly. It had to operate with thinner margins and less predictable support. That adjustment touched every market linked to dollar liquidity. The danger lies in permanence. A panic ends. A balance sheet can be recapitalized. Structural withdrawal sets a new equilibrium. Even if growth continues and crises are avoided, the operating environment changes. Liquidity becomes conditional. Volatility becomes persistent. Policy effectiveness declines at the margin. This reinforces the central claim of this documentary. The largest liquidity shock did not arrive as a single event. It arrived as a reordering of flows that redefined how the system functions. Its impact was not measured in days or months, but in years of adaptation. Compared to that, the crises of 2008 and 2020 were sharp interruptions. This was a quiet transformation, and its scale was larger precisely because it did not announce itself. History shows that empires do not lose influence all at once. They lose control of liquidity first. Power fades only after settlement systems strain, flows slow, and monetary authority becomes conditional. This sequence has repeated across civilizations that once appeared unassailable. The British experience offers a clear example. At the height of empire, sterling functioned as the world's settlement currency. Trade invoicing, reserves, and financial contracts depended on London's ability to clear obligations smoothly. Britain's decline did not begin with military defeat or industrial collapse. It began when sterling shortages emerged. After 2 world wars, Britain lacked the external surpluses needed to supply liquidity to the system it managed. Capital controls, currency pegs, and emergency measures followed. Sterling still circulated, but it no longer flowed freely. Monetary influence narrowed long before political power fully receded. The Dutch Republic followed a similar path centuries earlier. The guilder anchored European trade during its golden age, supported by commercial networks and financial innovation. Over time, surplus capital accumulated, but domestic opportunities diminished. Liquidity stagnated, capital sought safety rather than expansion. The guilder remained respected, yet its role contracted as flows shifted elsewhere. The Netherlands did not collapse. It adjusted to a smaller role after losing monetary centrality. Roman precedent pushes the pattern further back. Rome did not fall when it ran out of resources. It faltered when settlement failed. Taxation relied on timely delivery of grain, coin, and goods from distant provinces. As transport slowed and administration weakened, flows became unreliable. Soldiers went unpaid. Contracts broke down. Confidence eroded. Authority diminished because obligations could no longer be settled consistently. Political fragmentation followed monetary dysfunction. Across these cases, the pattern is consistent. Empires maintain power by controlling settlement, not by hoarding wealth. When liquidity circulates smoothly, authority extends outward. When it slows, control contracts inward. The loss is gradual and often misunderstood by contemporaries. Leaders focus on visible metrics while the system's plumbing deteriorates. What unites these precedents is not mismanagement or moral failure, but scale. Large systems require surplus recycling to function. When recycling falters, the center must absorb stress it was never designed to carry alone. Adjustments follow tighter credit, higher volatility, and reduced reach. These changes appear technical, but their implications are strategic. This historical lens clarifies the present. The erosion of liquidity control does not announce the end of power. It signals transition. Markets adapt before politics does. Financial behavior changes before narratives catch up. By the time decline is debated openly, monetary primacy has already weakened. Empires rarely recognize this moment. They remain influential, wealthy, and militarily capable while liquidity slips. That lag creates false confidence. History suggests that once settlement dominance is lost, recovery is unlikely. Power continues, but on narrower terms. The sequence repeats because the mechanics are structural, not cultural. Understanding this precedent reframes current events. The question is not whether power disappears, but how its foundations change. Liquidity control is the first indicator, and history is unambiguous about what follows when it slips. This outcome does not require villains. It does not depend on miscalculation, hostility, or intent. It follows from structure. Any system built on sustained external recycling carries within it the conditions of its own adjustment. When the scale grows large enough, dependence becomes exposure, and exposure eventually demands change. The global dollar system functioned because surplus nations chose to recycle capital back into U.S. assets. That choice was rational for decades. It supported export growth, stabilized currencies, and provided a reliable store of value. Over time, however, the volume of recycling required increased far beyond what was necessary for trade settlement or reserve safety. At that scale, participation ceased to be neutral. It became a strategic constraint. History shows that this phase always ends the same way. Surplus holders reassess, not because the system fails, but because their own balance sheets grow too large to be passively managed. Concentration risk increases. Political risk becomes material. Optionality declines. The rational response is diversification, insulation, and selective participation. These decisions are administrative, not ideological. From this perspective, China did not break the system. It revealed its fragility. The system's stability depended on continued behavior that was never guaranteed. It relied on habit, not enforcement. Once that habit weakened, the underlying dependence became visible. This inevitability is often misunderstood because the system appears robust until the moment it adjusts. Markets remain liquid. Growth continues. Institutions function. The absence of crisis is mistaken for permanence. But structure matters more than appearances. When incentives shift, behavior follows, even if the change is slow. Importantly, this process does not require a replacement system to be ready. Adjustment begins before alternatives fully mature. Liquidity fragments before new anchors consolidate. That interim period feels unstable, not because collapse is imminent, but because coordination weakens. The system transitions from uniform behavior to differentiated behavior. Blame obscures this reality. It implies that different choices could have preserved the status quo indefinitely. History suggests otherwise. No reserve system based on external recycling has maintained dominance permanently. The scale eventually overwhelms the mechanism. What changes is not whether adjustment occurs, but how smoothly it unfolds. Seen through this lens, recent developments reflect exposure, not sabotage. The system did not fail a stress test. It encountered a maturity test. Surplus holders reached a point where preservation outweighed accumulation. That choice was inevitable, regardless of geography. Understanding inevitability reframes the narrative. It shifts focus from actors to architecture. It explains why policy responses felt constrained and why interventions stabilized markets without restoring past conditions. The system adjusted because it had to. This does not mark an end. It marks a transition. Fragility was always present, hidden by cooperation and scale. When cooperation became optional rather than automatic, fragility surfaced. The system continues to operate, but on different terms. That outcome was not imposed. It emerged naturally from the structure that made the system powerful in the first place. What follows this adjustment is not collapse, but fragmentation. Liquidity does not disappear. It reorganizes. Instead of flowing through a single dominant channel, it pools regionally, governed by different incentives and constraints. Capital still moves, but less uniformly. Settlement still occurs, but with more friction. The system remains global in scope, yet less integrated in practice. Regional liquidity pools are the natural outcome of this shift. Trade settles closer to home. Reserves are managed with greater diversification. Financial relationships deepen within blocks rather than across them. This does not require formal alignment or new institutions. It emerges organically as actors prioritize reliability over reach. Liquidity becomes contextual, abundant in some corridors and thinner in others. One immediate consequence is higher baseline volatility. When liquidity is centralized, shocks are absorbed by scale. When it is fragmented, shocks travel unevenly. Price discovery becomes less smooth. Correlations weaken. Assets that once moved together begin to diverge. Volatility is no longer an event. It becomes a feature. Safe assets also change character. They do not vanish, but their reliability becomes conditional. An asset may be liquid in one region and less so in another. Its behavior in stress becomes harder to predict. Safety shifts from universality to specificity. Investors adjust by demanding higher compensation for uncertainty, even in instruments once considered risk-free. Monetary reach narrows as well. Policy still matters, but its transmission weakens beyond domestic borders. Interventions stabilize local markets, yet their global impact diminishes. Central banks retain influence, but less authority over external behavior. Liquidity provision becomes more targeted, less expansive. None of this implies disorder. It implies adaptation. The system continues to function because incentives align locally, even if they diverge globally. Trade continues. Finance evolves. What changes is the assumption of uniform response. Markets stop behaving as a single organism and start behaving as connected but distinct systems. This transition rewards awareness and punishes complacency. Structures built for seamless global liquidity struggle in an environment of selective participation. Strategies that assumed automatic recycling face higher costs. Risk management becomes more important than optimization. Margins shrink not because opportunity disappears, but because predictability declines. Importantly, this is not a judgment on any actor or policy. It is the logical outcome of scale, maturity, and incentive alignment. Fragmentation reflects adaptation to a world where cooperation is optional rather than assumed. Systems recalibrate accordingly. The era that follows is quieter than crisis narratives suggest. There is no single turning point, no final break. Instead, there is gradual differentiation. Markets learn new boundaries. Institutions adjust expectations. Liquidity finds new paths. The danger lies only in denial. Transitions do not announce themselves as endings. They unfold as new norms. Those who continue to operate as if the old system remains intact face increasing friction. Those who recognize the shift adapt early. This moment marks neither decline nor triumph. It marks a change in operating conditions. The global system moves from singular liquidity to plural liquidity. That shift reshapes risk, opportunity, and power. Understanding it is not a matter of fear, but of realism. Transitions are manageable. Complacency is not.